Salam alaikum wa rahmatullah. Bismillah, alhamdulillah, salatu wassalam ala rasulillah. In the name of Allah, all blessings be to Allah, present blessings be upon His Messenger Muhammad sallallahu alaihi wasallam. I wanted to start off, and first of all, it's an honor to be here, and thank you very much for NCF, BNP, Center for Islamic Wealth Management, MIFC, for allowing me the opportunity of sharing with you a little bit about Islamic investing and managing risk. It's actually a fairly detailed topic, but I'll try to kind of skim through it, give you the highlights of it, and then hopefully in Q&A I'll be able to answer maybe some more specific questions regarding that. But before I begin, I did want to put this one comment up here. I know there's a lot of NCF professors and PhD candidates that are out there, and basically there's an inverse relationship between wealth and professors, or risk, if you want to call it so. Introductory point for my presentation. The other thing I wanted to also mention, if from a concept of, from an Islamic concept, we were talking about this as I was putting this together, this presentation, and the concept is that without risk, there's no risk. You think about that for a second. So in Malaysian, you can say, without any risk, in the English language, there's no Rezeki, right? That's how they say it in Malay. So that's an important concept to be able to take in mind, is that if you take away all of the risks that are there in life, you'll be stuck in your closet with the door closed and the lights off. However, even that has its own risks as well. So there's really no way you can get around risk. In the banking sector, you transfer risk, or the insurance sector, you transfer risk. In the banking sector, you mitigate risk. In the investment realm, you embrace risk. And that's risk is actually what causes you to get the actual return. So Saturna Lam, I have this quote up here. We tend to think of risk in predominantly negative terms. It's a bad thing. I want to stay away from it. I want to mitigate it. I want to get rid of it, those type of things. But as something to be avoided, or a threat that we hope we won't materialize. In the investment world, as I mentioned, however, risk is inseparable from performance, and rather than being desirable or undesirable, is basically it's just simply necessary. It's a necessary thing we have to have, and then how do you kind of deal with it from there? And so that's something that's very, very important. And so the understanding is the key component of risk, and is one of the most important parts of the financial education model, meaning that there's multiple different players when it comes to the Islamic financial industry, and the best thing you can do to be able to deal with the risk is to understand it, not get rid of it, but to understand it and then be able to deal with it. And it is something that is quantifiable both from an absolute and from a relative term. So again, looking at it from the criteria of the different types of securities in the fund management industry, in the public markets, there's multiple different types. All of them has risk. Okay, even the cash that you keep in a bank account, there's risk in it. And then but as you go along, if you want to call it the time horizon, and then at the same time how much risk you actually take, what happens is that the shorter term, the shorter the time horizon, typically the less risk you want to take, and the less risk there is in the actual product itself. And the longer term you go, then you actually end up taking on more and more risk. And so that's something very, very important. So, as you go along, you have commercial property, which is more riskier than, for example, corporate investment grade sukuk. The residential property is more risk. And then you get to high yield corporate sukuk, emerging markets. And one thing that I wanted to also mention, commodities generally have always been perceived as a very, very high risk investment. They're cyclical in nature. They go up and they go down. And then gold, on the other hand, has actually traditionally been a very, very good preserver of wealth. Right? So historically, if you look at gold, it actually just matches inflation and just kind of keeps chugging along. However, in the past, let's say 10 years or so, that's completely changed. And people are still living in that mind frame that gold is a good preservation of capital, meaning it's the alternative of cash. But to give you an idea, the cumulative, if you look at the past 1 year to date, gold has actually down about 8.5%. Over a 3-year period, it's down 35% on a cumulative basis, and over 5 years, down about 23%. So it's no longer that value that you think it is, and we need it takes education to be able to teach people that maybe, if you want to preserve cash, you shouldn't be putting into gold, because it might be something that when you need it the most, the gold is actually at the least value that you could have actually gotten for it. And so those are things that we need to think about when we think about risk. And then this is another way to put the same thing as well. At the very bottom, if you look at your own financial assets or where the risk level lies, and the very, very bottom of that is going to be cash and cash equivalents. Then you have, low risk investments, which is a little bit smaller of your investment pool. That's where you would get sukuk funds, sustainable fixed income funds, those type of things. And then you have basically the general market of moderate rate investments. So blue chip stocks, quality growth stocks, those type of things. And what I'll talk about in this presentation, we have two funds, the ASEAN Equity Fund and the Islamic Equity Fund, both lie in this area, and that's where a majority of the actual investments will lie when it comes to public markets. And then the last one, which obviously you want the smallest amount of money, would be private equity, venture capital, because think about the risk it takes to be able to say, okay, I'm going to make 10 investments, and I pray that one of them turns out to be really well. And that one investment that does really well has to make up for the 9 investments that we're losing. Right? That's the idea of how risky that investment can be. And so generally the risk that when you ask people is, they ask you, well, how much risk am I able to take? And my general answer is, well, how much money are you willing to lose? Right? If you're willing to lose all of it, then you can have 100% gain or more. If you're not willing to lose any of it, then you're better off with a 0% or inflation matching rate of return. So that's kind of the general idea of being able to do that. And then from a fund management perspective, there's many different of risks that we operate under. There's operational risk, right? To be able to prevent fraud. What are the processing controls that are in place to be able to do that? There's legal and compliance risk, or basically this part of it is the risk of going to jail, or getting fined. And so how do you mitigate that? You basically have a very, very clean shop. Or unfortunately, in the conventional world, which is not very, very in the banking sector, right? Which is, think about it from an ethical perspective. They basically quantify even the amount of fines they can get and whether or not it's worth it to be able to do that or not. So, for example, one particular bank might say, yes, we know we're doing something that we're dealing with drug money from Mexico is illegal, but we know from a historical perspective that they're only going to get fined $2 billion. And so over the next 5 years, which we won't get caught, we'll be able to make $15 billion. And so if you look at it from a risk and reward level, you say, okay, probably it's worth it. I can make $13 billion and be able to do that. So there is that formula that you can use, however unethical it is, that is used in the commonplace. And then there's business risk also. Key person risk is probably a lot more aligned with private equity. Key person risk, your risk of reputation, all of those things. And then the last one, which is what I want to focus on in my particular talk, is market risk, liquidity, leverage, diversification, and failure of the model that you're actually using to make those investments. And again, we talked a little bit about the market risk, the volatility, liquidity, interest rates. I'll talk about these in a lot more detail. But there's a two-sided coin here when you're talking about Islamic fund management. When you're talking about private wealth, it's usually sophisticated investors you're dealing with. They understand risk, maybe. They understand how to make money, maybe, and all of those things. However, when you're dealing with funds, you're generally talking about retail, and so you're dealing with quote-unquote, not necessarily, but quote-unquote uneducated investors. You have to educate them about their emotions when it comes to investing, or their fear, getting panicked in situations, all of those different types. There's an education that has to go on. And then in the middle between the fund manager and the end client, there's also advisors, and they have the same risks or the same emotional behaviors as investors do. But at the same time, you have other risks that are there as well. And so you have, the risk of them having an investment advice that is biased. You have risk of basically giving them poor investment advice, or investment advice that pockets them rather than the investor. So all of those things are there that we have to kind of deal with. But again, like I said, later on in the presentation, I'm going to talk more about market risk. But I wanted to talk a little bit about investor behavior, and this next slide is going to be very, very pertinent to even probably a lot of people in this room. But the way to overcome investor behavior is through education. That's the only way you can get rid of it. What do I mean by that? So let's take a look at the average life cycle of a stock, right? And so here, I don't know if you can read this or not, but first of all, you come in and say, the price is going up. Let's watch the market, and I'll see exactly when I want to buy it. And then next one. Oh my God, I just missed the consolidation phase. I don't want to lose any more money, so I'm going to buy it right now. So you end up buying it when it's a little bit higher in price. And then it's like, wow, good thing I bought it, right? I didn't wait for it because I actually made money. And then you go down and it's like, oh, wait, it's the car, and after the stock comes down, right? It's like, ouch, as soon as it goes back up a little bit, I'm going to get back into it. I'm going to get out of it because now I can't handle it anymore. And then the next one is like, enough, I've had enough of it. I'm selling all of my entire position and I'm staying out. I'm never going to get back into the stock. And the stock market's really bad and real estate is the only place to be. That's usually what people say. And then it's when it goes down a little bit lower, you're like, oh wait, I'm so glad I stole out of this stock. I could have lost more money than I actually did. And then when it goes a little bit bouncing on the bottom and then goes straight back up again, you're like, whoa, wait, I should get back into the stock because it's actually made money. It's going to make a lot more, and I'm going to get back in, and the whole cycle starts all over again. And so this is actually the investor behavior, but this can happen in one particular stock, but it can also happen on the fund level as well. And because if every investor did this on a fund level, meaning that they said, I'm going to buy the fund when the market is high and sell the fund when the market is low, then the manager has to manage the cash flows of the purchases and redemptions. And what's going to happen is they're going to buy because purchases are coming in when the market's at the top, and they're going to sell when the redemptions are going out when the market's at the bottom. That's the opposite of what the manager wants to do. The manager wants to buy at the bottom and sell on the top, but because of investor behavior, if you don't educate your investors, you'll end up doing the opposite thing. There was actually a study that was done. I can't remember the name of the firm, but they have, it's a fairly large firm in the US, very, a lot of mutual funds. They went out to their average mutual fund, and they said over a 10-year period, right, there was the average mutual fund that they had a rate of return of about 8%, which is pretty good. They had 8% rate of return. And then they went to the investor and they looked at the investors in the funds across all of their funds, and they said, what was the average rate of return? And they found that the average rate of return for the average investor was 3%. Now, how is it possible that the average fund was doing 8% when the average investor was only doing 3%? This is the answer, is that they were always getting in at the wrong time and always getting out at the wrong time. And so you have to be able to manage that. So that's enough of investor behavior, but it's a very, very big component of making investments from a fund management perspective. And the last one, obviously, what is the definition of a long-term investor? Is a short-term investor who waited too long, right? That's typically what it is. Everybody starts off as a trader, and then you end up holding 20 stocks that are all down on you, and why do you hold them? Because, well, you couldn't get out of them in time. So again, what I'll be talking about in this, when you're talking about risk, is one of our funds that we have. It's a wholesale fund right now. We're converting into retail. It's the ASEAN Equity Fund that I want to talk about. And first of all, I'll highlight the risk, and then we'll talk about them individually. This was actually directly taken from the information memorandum. So I just want to highlight some of the risks that we think about even when we're disclosing to the public what it is that we're actually doing. So what is the investment objective of the fund? It seeks long-term capital growth. Long-term capital growth is the risk because people might not have long-term in mind. And at the end of the day, what is long-term? Because at the end, all of us are dead anyway. So that's a risk that's there also. So the fund generally invests in a diversified portfolio, right? What does diversified mean? Does it mean 20 stocks? Does it mean 50? Or does it mean if you get too much diversification, you're not going to get any rate of return that's beating the market? And so what does really diversification mean? It generally follows a relative value investment style, favoring companies with potential for earnings growth. Well, what if a company doesn't have the earnings growth that you wanted it to have? That's a risk. In the direction of the gross domestic product, inflation is a risk, right? What is the inflationary environment in the economy? Currency is actually another risk. What's happening versus your own currency in the investments that you're making, for example, in the ASEAN fund, what's happening in Indonesia, in Malaysia, in Singapore, Thailand, relative things like that. And then government risk also is another one, right? Political risk that's also there. The stock selection, right? What if you don't make the right selection? That's another risk that's actually there. Investors for the long term with an annual portfolio turnover not to exceed 30%. Again, if you have low turnover, maybe there's more risk than somebody who had a higher turnover because you could sell in time, maybe not, something along those lines. So the turnover is a risk as well. And then the other one, basically, we don't invest in debt, and so typically debt is considered less risky. So is that a risk to be able to only be in equities, moving into the investments from there? So there's a lot of risks that you can come out with when it comes to investments from that perspective. Right? So you can think about it from this perspective. I mean, how long are you going to be able to to get away from all the risks that are out there, you're not going to be able to. So really, we have to come up with a new approach, maybe, to risk management, just basically hiding yourself in a closet, or in this particular case, putting pillows around you, wearing sunglasses, and a hat to protect yourself from everything that's out there. So what are some key risks that, as I mentioned earlier, that we talked about, right? So price level risk is one of them. So inflation, right, is going to erode the value of investment that you have, and basically invest in the fund. So what do you have to do for that? How do you mitigate that? You buy companies that maybe are inflation, basically are up, keep up with inflation. For example, commodities might be one that might be keeping up. Real estate might be another. So you want to be in sectors that can actually do that. But then on the other side of that, you have inflation, but on the other side, you have deflation as well. And so right now, Europe is going through a deflationary environment, so is Japan. And so what do you do what is the deflationary risk? Is that the debt that you actually take on as a company, the typical model for capitalism is that you take on debt for 30 years, and at the end of those 30 years, you're paying back a little bit less because of inflation eats into it. On the other side of that is deflation. So for example, if you take on debt and you have a deflationary environment, every single day you wait to pay off that debt, you're going to lose money because you're having to pay more for that than you actually could. And so how do you mitigate that type of risk? Well, then the Islamic finance comes in really well. You try to stay away from companies that are very, very heavy in debt. Another one is concentration risk, right? So you have a diversified portfolio, but maybe all of the good companies that are going on right now in ASEAN is only having to do with the consumer discretionary sector. Do you still want to buy, for example, commodities for diversification, even though you know that the cycle in commodities is going down? So how do you kind of look at it from that perspective? And so you have to balance between having a less concentrated portfolio and then an overall concentration in one area that might make you money for the short term, but in the long run might be too risky to be able to do. Country risk is another one, right? Risk of political or economic instability. For example, if you invest in Thailand, you know that every so often they do really well, and all of a sudden either they have a coup, they have flooding, they have something that happens every 2-3 years that Thailand always gets stuck in a cycle. And you can say that about different countries as well. So what is their political environment? How do you deal with it? What do you do in an environment where you go in and you buy a company that you think is really well, for example, in the coal sector, and then the government comes in, even in a democracy comes in, and they want to nationalize the entire coal industry. That's a risk that's out there. So how do you deal with that? You kind of have to be aware of it. And again, the idea here is not to get rid of the risk. The idea is not to get rid of it. The idea is to look at it and say, is this risk tolerable? And am I going to get a rate of return that matches the risk level that is being taken on? So for example, if I go into a country that has a history of nationalizing its national industries, if I want to buy a certain a company that maybe might get nationalized, I better get a really good rate of return on that. For the risk that I'm going to take, then the government might take it over, I might lose all my money. So that's the kind of thing you want to be able to do. So it's balancing between risk and reward. And each of these different ones are exactly the same thing. Currency is another one. Our fund is denominated in MYR, in ringgit. However, it's invested in other countries, so there's a currency translation, right? So if the Malaysian ringgit does really well relative to those, you're going to lose value even though you had really good investments that were making money, right? So for example, if I went into Vietnam and said I wanted to buy a company in Vietnam, Vietnam has a history, for example, of every couple of years, they devalue the dong. If they devalue it in the past 3-4 years, they've done it twice, and they've done it 50% every single time. What that means is that your 2-year average rate of return had better be more than 50%, or you would have lost money. Right? How many investments do you know that go up more than 50% in 2 years? So again, how do you deal with something along those lines? And for us in this portfolio, so far we've said Vietnam is too risky for us. We don't know what the government's going to do. There's great companies in Vietnam. Vietnam's going to do really well with the TPP coming into fruition. However, it's too risky for us as a fund, for our investors to be involved with, and so that's why we actually stayed away from it. And then there's also, those are all the exogenous factors, right? What do you do? But then also there's internally to the actual stock itself. So then you have the currency risk, the macro risk, country, currency, nationalization, all of those things. Then you get down to the actual company itself, and you have multiple risks as well, whether it be a standard deviation risk, right? Can you actually create alpha, basically, the above expected rate of return? The higher the number, the higher the risk, but you have to, again, be able to manage that. And then, can you manage the beta as well? The beta basically means that a beta of 1 means the market itself. And so if you have a 1.1 beta, that means you're more volatile than the market. If you have less than 1 beta, you have less volatility than the market. And then, so how do you, A, look at the stock itself and say, am I willing to take the risk of being maybe a 2, double the volatility of the market, and what type of rate of return will it give me, and it's sufficient enough for me to take on that risk that I'm willing to take. And then there's also non-Sharia compliance risk, right? And this can come in many, many different forms. This can come in the form of, I bought into a company that was Sharia compliant, and then all of a sudden the management decided, because we don't control the company, management decided they're going to go out and borrow money. And it violates the screen. Now I'm stuck with a company that's non-Sharia compliant that might not be making any money for me. So what do I do in that situation? That's one part of it. The other part of it is mergers and acquisitions. For example, like I buy into a company that's in technology, and they decide to go out and buy a media company. It's happened before. AOL did it with Time Warner. And so what do you do in that situation, right? So all of those Sharia non-compliance at risk, that's on the investment side. But on the non-investment side is that there's a shareholder that comes to me and says, wait a minute, what you're buying into is really not even Sharia compliant, right? And then you have to go through an education process of telling them what is Sharia compliant, what's not. Our Sharia advisor said yes, those type of things as well that are going forward. So there's a lot of risks, obviously, that are actually there. And then as we're closing off, I know we talked about a lot of risk here, but there's also additional risk, and again, it's a matter of managing them and accepting them, embracing them, and saying, how do we take these on, right? Environmental, right? ESG. ESG has very, very similar risks to Sharia compliance risk, where, for example, in the environment, social, governance, you can say you're ESG, but what if you're really not? So, for example, there was a fund company in the US that actually had all their brochures and everything along those lines that said, this is how we follow SRI principles. And then when the SEC came in and audited them, they said they figured out they weren't really following those principles at all. And so not only they were fined, but they were pretty much castigated for doing that. And so again, you have a risk of being able to do the ESG screens. How do you do them, and whether they're accurate, and all of these things are there. Sustainability is the same thing. And then the governance part of it, reputational risk is very, very important as well. Right? When you do something wrong, the last thing you want to do is be a Sharia compliant manager where the industry and the public thinks you're no longer Sharia compliant or you don't know what you're doing. And unfortunately, this reputational risk is very, very common within Islamic finance. So many people out there think about Islamic finance and say, well, that's the same thing as banking. You're just putting an Islamic label on it. That's a reputational risk for us. That's a potential market that we will never be able to capture unless we convince them otherwise. And then the other one, obviously, the risk is force majeure, right? Hurricane comes through, there's an earthquake, there's a tsunami, all of those things you have to be able to take on. And so again, the idea is that you have all of these different risks that are there. I primarily focused on the investment part of it, the market risk, liquidity risk, all of those things. But it's a constant cycle, and it's constantly changing, right? So you have the operational risk that might 2-3 years from now look different than it used to before. I mean, let's say 50 years ago, there was no technology risk to a company, but now there is. Now now that you've put all your data onto the cloud, now you have security risk where you might have had before. So all of those different things, like regulatory-wise, the regulations are changing, all of these different things. But typically, even in the market perspective, all of these things are what we talk about. So inshallah, with that, I'll close. Hopefully I've left you with some food for thought and not scared you into thinking that everything out there has risks. But again, I close with the saying that without any risk, there's no risk. Thank you.